The United States government owes $38 trillion. The debt is growing at an accelerating rate. Interest payments on this debt have reached levels that now rival our largest spending categories, including national defense. Most people assume this debt will eventually be paid back through some combination of economic growth, spending cuts, or higher taxes. That assumption is wrong. The debt won't be paid back. It will be erased through a mechanism most people don't understand until they feel it in their grocery bills and retirement accounts. The government isn't planning to default. They're planning something quieter. They're going to make the debt disappear by destroying the value of the money it's measured in. But the government can't just print money and hope for the best. To make $38 trillion vanish without triggering a panic, they need a specific three-part formula that's already running in the background of your financial system. I'll show you exactly how that formula works in a moment. When a government reaches the mathematical limits of its debt capacity, three paths emerge. Only one of them works politically. The first path is austerity: cut spending dramatically, raise taxes across the board, run primary surpluses large enough to actually pay down the principal. This worked in the 1990s when debt levels were manageable and the economy was strong. It doesn't work now. Social Security and Medicare represent mandatory spending that grows automatically as the population ages. These programs alone consume more than half the federal budget. Cutting them triggers immediate electoral consequences. Any politician who proposes reducing benefits by the amount needed to matter gets voted out in the next cycle. The math is brutal. To balance the budget through spending cuts alone would require eliminating the entire military. To balance it through tax increases would require roughly doubling income tax rates across all brackets. Neither approach is politically survivable. But there's a deeper reason the government won't choose austerity. It actually makes the debt problem look worse. When you cut government spending during a period of elevated debt, you remove demand from the economy. GDP contracts. Tax revenues fall. The debt to GDP ratio actually worsens even as you're cutting programs. You get all the political pain of austerity with none of the fiscal benefit. The math punishes the very action that sounds responsible. Imagine you're sitting at your kitchen table with two credit cards. One is maxed out and the other is your only way to pay the interest on the first. Most people call this a disaster. In Washington, it's just Tuesday. But what happens when you decide to simply stop paying? The second path is explicit default. The government announces it will not honor its obligations. Argentina did this in 2001. Russia did it in 1998. Both experienced immediate economic collapse. For the United States, this option is effectively impossible. Treasury bonds form the foundation layer of global finance. Every major bank treats them as risk-free assets for capital requirements. Pension funds park retirement promises in them. Insurance companies use them to back policy obligations. The entire repo market uses treasuries as collateral. If the United States defaulted, the cascading effects would be immediate. Banks would become insolvent overnight because their safe assets just lost value. Pension funds would face massive shortfalls. The global trade system, which settles in dollars backed by the full faith and credit of the US government, would seize up. Credit markets would freeze. We're not talking about a recession. We're talking about the collapse of the financial architecture that enables modern commerce. But there's a second reason default is impossible: the government's secret advantage. Most US debt is owed in dollars, and the US government controls the supply of dollars. This creates an option that countries like Argentina and Russia never had. If default is impossible and austerity is political suicide, the government is left with a third way. It's a strategy that was used to quietly erase the massive debts of World War II. And the blueprint they used in 1945 is being dusted off for today. That leaves the third path: financial repression. This is the soft default. The government pays back every dollar it owes, but those dollars buy significantly less than when they were borrowed. The mechanism is simple. Keep nominal interest rates below the inflation rate. If the government borrows at 2% and inflation runs at 5%, the real interest rate is negative 3%. Every year, the debt burden shrinks by 3% in purchasing power terms. The bondholders get their money back, they just can't buy much with it. This approach avoids immediate crisis. There's no dramatic announcement. No emergency meetings, no market panic. The debt gets liquidated slowly, year after year, through the steady erosion of the currency's purchasing power. Bondholders receive full nominal repayment. The government's balance sheet shows the debt being serviced. But in real terms, in terms of what that money can actually purchase, the debt has been partially defaulted on. This is the path governments choose when the other options become impossible. It's happening right now. But how does a government actually execute a soft default without triggering a panic? It starts with a deceptively simple formula. Most people look at their bank balance to see if they're getting ahead, but the government uses a different calculation, one that's never printed on your statement. It's a simple equation, but it's the primary tool used to transfer wealth from your pocket to the Treasury without you ever seeing a tax bill. Here is that formula. Financial repression operates through a deceptively simple formula. The real interest rate equals the nominal interest rate minus the inflation rate. When that number turns negative, wealth transfers from lenders to borrowers. Here's what that looks like in practice. You put money in a savings account paying 1% interest. Inflation runs at 5%. Your real return is negative 4% every year. Your savings lose 4% of their purchasing power. At that rate, your money loses half its value in roughly 14 years. You received interest payments. The bank statement shows growth, but in terms of what you can actually buy with that money, you got poorer. Now scale that mechanism to government debt. The Treasury borrows $1 trillion at 2% interest rates. Inflation runs at 5% for a decade. The real value of that $1 trillion shrinks by roughly 30% over the period. The government makes every interest payment. It repays the principal in full, but the purchasing power of what it paid back is 30% less than what it borrowed. The bondholders took a loss. They just didn't realize it until they tried to spend the money. This mechanism requires three tools working in coordination. The first tool is interest rate suppression. Central banks must keep yields below the inflation rate for extended periods. The historical example is clear. From 1942 to 1951, the Federal Reserve pegged long-term Treasury rates at 2.5%. This was explicit policy. The Fed committed to buying any amount of government bonds necessary to maintain that yield ceiling. Inflation during much of this period ran higher than 2.5%. Real rates stayed negative. And the modern equivalent is more subtle. It comes through forward guidance and yield curve control. The central bank signals it will keep rates low for an extended period. It purchases bonds to suppress long-term yields. The effect is the same. Rates stay below inflation. Real returns turn negative. This is where the story gets uncomfortable. You might think your bank holds government bonds because they're a good investment. The truth is more unsettling. There's a hidden set of global rules that effectively forces the financial system to fund the government's debt, even when it's losing money. We'll look at those rules next. The second tool is regulatory capture of the financial system. Banks and institutions don't buy government debt just because they want to. They buy it because regulations force them to. Basel III banking regulations designate U.S. Treasuries as high-quality liquid assets. Banks must hold these assets to satisfy liquidity requirements. It doesn't matter if the real yield is negative. The regulations mandate the purchase. Pension funds face similar constraints. Insurance companies must hold government bonds to back policy reserves. The system creates a captive audience. These institutions must buy government debt regardless of the return. This artificial demand keeps yields suppressed even when inflation is elevated. The third tool is inflation management itself. The target becomes flexible. When the stated goal is 2% inflation, but actual inflation runs at 3% to 5% year after year, that gap matters. The methodology for measuring inflation can shift over time. Substitution effects get introduced. Quality adjustments reduce the reported price increases. These methodological changes create structural incentives where the official number may diverge from lived experience. This allows the government to run higher actual inflation while claiming to stay near target. These three tools create the wealth transfer mechanism. The government borrows at suppressed nominal rates. Inflation runs persistently above those rates. The real value of the debt shrinks year after year. Bondholders receive full nominal repayment but can purchase far less with it. To understand how effective this strategy can be, we need to look at the last time it was deployed at this scale. The post-World War II era provides the complete blueprint for what's happening now. We remember the 1950s as an era of unprecedented prosperity, but there's a part of that story that's been scrubbed from the history books. The greatest generation didn't just work their way out of the war debt, they were the victims of a systematic liquidation of their savings that most of them never even realized was happening. Step back to 1946. The world is quiet for the first time in 6 years. The soldiers are coming home, but they're returning to an economy that is technically insolvent. The United States emerged from World War II with a debt to GDP ratio of 116%. The United Kingdom's ratio hit 216%. These were peacetime debt burdens on a scale never before seen. Default was unthinkable. Austerity would have triggered another depression. The solution was financial repression implemented through the Bretton Woods system. The 1945 blueprint had three main pillars. First, capped interest rates that stayed below inflation. Second, captive buyers forced to hold government bonds. Third, closed exits that prevented savers from escaping to foreign assets. As we look at how they executed this strategy, watch for these three elements. They're the exact same tools being deployed in your financial system today. For 3 decades, the Federal Reserve kept interest rates capped while inflation averaged between 4% and 6%. The Fed maintained control over the yield curve. Long-term Treasury rates stayed around 2.5% through the 1940s. When inflation spiked after the Korean War, rates remained suppressed. Real interest rates turned negative for roughly half the period between 1945 and 1980. Capital controls prevented savers from seeking better returns abroad. You couldn't easily move money to foreign markets. Banking regulations forced institutions to hold government debt. The system created a captive market where bond buyers had limited alternatives. The government could borrow at rates below inflation because the financial system was structured to ensure demand for its debt. The effect on debt levels was dramatic. US debt to GDP fell from 116% in 1946 to 66% by 1955. By 1980, it reached 30%. The United Kingdom saw similar patterns. France, Italy, and Australia all reduced massive war debts through the same mechanism. Reinhardt and Sprancia calculated the liquidation effect at roughly 3% to 4% of GDP annually. This exceeded the contribution from primary budget surpluses. It exceeded the benefit from GDP growth alone. The largest factor in debt reduction was the steady erosion of the debt's real value through negative real interest rates. Someone paid for this debt reduction. The cost fell on savers. Every household that held government bonds watched the purchasing power of those bonds decline year after year. Every worker who put money in a savings account earning 2%, while inflation ran at 5%, lost 3% annually in real terms. The middle class effectively paid for World War II twice. Once when they bought war bonds to fund the conflict. Again when those bonds were repaid in devalued currency over the following decades. The greatest generation funded the war effort and then absorbed the cost of debt reduction through the systematic erosion of their savings. This strategy worked because of specific structural conditions that no longer exist in the same form. Capital accounts were closed, financial innovation was limited, there were fewer ways to escape negative real returns. The Bretton Woods system of fixed exchange rates prevented currency collapse even as inflation eroded purchasing power. Strong post-war economic growth provided cover for the wealth transfer. The growth rates of the 1950s and 1960s made the pain less visible. When the economy is expanding rapidly, people don't notice as quickly that their savings are losing value. The rising tide of prosperity masked the systematic transfer of wealth from savers to the government. But the conditions that made post-war financial repression successful have disappeared. Capital moves freely across borders now. Financial markets are globalized. Savers have more options. Yet the incentives driving governments toward this strategy have only intensified. The debt burden is now comparable to 1946 levels. The political constraints against austerity are stronger. The mathematical impossibility of paying back the debt through conventional means is clearer. The playbook from 1945 to 1980 is being dusted off. The mechanisms are being updated for a modern financial system. The same strategy that liquidated post-war debt is being prepared for deployment again. The structural conditions that enabled post-war financial repression have largely vanished, but the debt problem has returned with greater intensity. US debt now approaches 130% of GDP. Interest payments exceed defense spending for the first time in American history. The demographic pressures that made post-war repression politically feasible have reversed. An aging population makes cutting entitlement programs impossible. Political polarization prevents any meaningful fiscal consolidation. This creates what economists call fiscal dominance. The debt level becomes so large that it constrains monetary policy. The central bank loses the ability to fight inflation without bankrupting the government. In the 1970s, when Paul Volcker needed to break inflation, he raised interest rates above 15%. The economy went into recession, unemployment spiked, but the debt to GDP ratio was only 30%. The government could afford those interest payments even at punishing rates. Today, with debt at 130% of GDP, the Federal Reserve cannot raise rates to 15% without making the debt mathematically unserviceable. Every percentage point increase in rates adds hundreds of billions to annual interest costs. At some threshold, interest payments would consume all tax revenue. The government would face insolvency not from inability to print money, but from the political impossibility of financing anything except interest payments. This means inflation becomes the release valve. When the central bank cannot raise rates high enough to control prices without destroying government finances, inflation persists. The debt gets liquidated through purchasing power erosion because no other option exists. Once you understand fiscal dominance, you stop being surprised by sticky inflation. You realize it's not a policy failure. It's the least destabilizing outcome available given the constraints. The Federal Reserve isn't fighting inflation poorly. They're managing debt sustainability within impossible trade-offs. That realization is the first step toward protecting your wealth in this environment. The tools of modern financial repression differ from the post-war era, but achieve the same effect. Quantitative easing replaces explicit rate pegs. The central bank purchases trillions in government bonds, suppressing yields across the curve. Forward guidance promises to keep rates low regardless of inflation. The commitment becomes, we will tolerate higher prices to maintain debt sustainability. This is where the story gets uncomfortable. You might think your bank holds government bonds because they're a safe investment. The truth is more unsettling. There's a hidden set of global rules that effectively forces the financial system to fund the government's debt, even when it's losing money. We'll look at those rules next. The second tool is regulatory capture of the financial system. Banks and institutions don't buy government debt just because they want to. They buy it because regulations force them to. They call these safety regulations. Basel III banking rules designate U.S. Treasuries as high-quality liquid assets. Banks must hold these assets to satisfy liquidity requirements. The language sounds protective. The reality is different. The safety being protected isn't yours. It's the Treasury's ability to keep borrowing. The government has effectively turned your local bank into a mandatory lender for the state. It doesn't matter if the real yield is negative. The regulations mandate the purchase. Liquidity coverage ratios ensure banks remain captive buyers of government debt even when real yields turn negative. Inflation measurement becomes a lever itself. When Social Security payments and Treasury inflation-protected securities link to official CPI, the government faces multi-billion-dollar incentives around how that number is calculated. Methodological Adjustments accumulate over decades. Substitution bias gets introduced. Hedonic quality adjustments reduce reported price increases. The gap between official inflation and lived experience can widen as a result of these structural incentives. The globalization constraint makes modern repression harder to execute than the post-war version. Open capital accounts allow savers to move money internationally. Financial innovation creates escape routes that didn't exist in 1945. In the post-war era, capital controls functioned because the system was closed. Today, decentralized assets exist outside the traditional financial system and cannot be inflated away through central bank policy in the same way government bonds can. This structural friction represents the primary difference between the 1945 blueprint and its modern application. The evidence of operational financial repression is visible in current policy. Real rates on Treasury bills remain negative for extended periods from 2020 through 2024. The Federal Reserve's balance sheet expanded significantly during what was labeled an emergency response. Inflation persisted above target for longer than initially projected. Banking regulations continue requiring institutions to hold government debt as high-quality liquid assets. These policies form a coherent response to the mathematical constraints of unsustainable debt levels. The debt won't be paid back in real terms through conventional means. The purchasing power erosion mechanism provides the path of least resistance given the political impossibility of the alternatives. Let's look at the silent default in your actual life. In 2020, $100 bought you a full cart of groceries. Today, that same $100 buys you a smaller bag, but the government's $38 trillion debt burden just got 20% lighter in real terms. You didn't get a tax bill in the mail. You just got a smaller dinner. The system effectively functions as a hidden tax on purchasing power. No conspiracy is required, just institutional incentives meeting mathematical constraints. Historical precedent shows this strategy can reduce debt burdens over decades. The cost falls on those holding currency and fixed income assets. Understanding the mechanism is the first step toward financial independence in an era of permanent fiscal dominance.